Hi everyone. This is the Federal's Big Money program, and I'm Giri Prakash, the host for this session today. I have Ms. Vidya Bala with me, and the topic of the discussion today will be on how, with the recent letting go of a whole lot of employees, either in the or in startups, how should they go ahead and manage their finances during the tenure of the layoff, and what they should do and how they should save their money, and a whole lot of issues that come forth when you are laid off, and you apart from the fact that you are going through a bit of a traumatic period in your career and in your life, you also have to be very careful with your finances. So let me introduce the guest today, Ms. Vidya Bala. Um, Vidya Bala is the founding partner and head of research and product for Prime Minister. She helped build one of the country's earliest robo-advisory solutions in the country in her earlier role at Funds India. And she was also the head of mutual fund research at Funds India, where she did some path-breaking work in analyzing funds and offering research portfolios. A chartered accountant by qualification, she began her career as a senior internal auditor with Ashok Leland, and then she went on to work for the Hindu Business Lines Research Bureau, where she tracked mutual funds, stock market sectors, and the macroeconomy for 8 years. She has more than 18 years of experience, of which 15 were spent analyzing the markets. Thank you, Vidya, for being part of the show.
Thanks, Giri, for having me in your show.
Yeah, so the first thing that I would like to ask you is that according to some research which was published in a few newspapers recently, in 2022, the quite a few startups and few tech firms also, at least in India, laid off around 25,000 people, and in January it has actually gone up further. And now you see a whole lot of mega big multinational giants like Meta and Google, Amazon, the parent alphabet of Google. They all are, and Twitter as well. They are letting go of people, and it's impacted India as well. In a situation like this, where getting another job is quite difficult, at least for the short term. Can you tell us what are the things that number one, how do you look at this scenario? Number two, what should employees do when they just sent an email saying that you've been laid off, and the next minute they are completely out of job and completely out of office as well?
Right, Giri. Yes, indeed. The last 2-3 months, we have heard big news of layoffs and firing happening. It all started with large numbers in the US, but is also, moving to countries such as India. Globally, of over the 200,000 layoffs that had happened, the rough estimate is that about a third could be Indians, because a majority, about 75% of visas issued are typically for, Indians who are,
Yeah.
working, who are sent to work abroad. So that number has largely been in the US, but we have heard of those companies also firing, having layoffs in India as well, in their Indian offices. And like you said, startups. Some of our favorite startups like, Swiggy and Zomato and all of, these popular ones have, started layoffs, if not in thousands, but in hundreds. And it has been growing so much so that now there is a monthly tracker that's happening globally on, in February, I think till last count globally has been about 18,000 layoffs. And I think a few thousands can be attributed to India. So that's, and largely this comes from the tech, fintech, and the general startup space. I mean, the tech-enabled startups largely, and that is where much of the employment has been generated. So it will definitely impact the lives of many individuals and savers and those who are having families. So the first thing is, when people receive such an email, obviously apart from the emotional turmoil that one would go through, the immediate thing on them would be about how to manage their finances, right? So there are two aspects to managing finances. One is to deal with the day-to-day expenses and the loans, if people have loans, and the other is about their own investments and savings that would also get disrupted because of lack of a monthly revenue stream until you get a next job. So these two issues need to be kind of dealt with separately. Obviously, the good thing with savings and investment is that it is okay not to be saving for a few months. So if you have your SIPs running or any monthly RDs and so on running, I think in the interest of saving up for the immediate need, it is fine to kind of stop those for a while. So one need not feel anxious about stopping their investment journey for a few months. You can always catch up. So that's something that investors kind of need to understand, and their fears need to be alleviated on that front. What needs immediate attention is the household running expenses, and also the very importantly the loans. Um, so in on the loan side, I think the EMIs are the biggest worry for most people, and defaulting on an EMI, as most of us will know, will impact our credit score. And this can have a big bearing on the future loans that you take also. So keeping that in mind, I think it's very important that one tries to first, pay their loans from the existing savings in hand as much as possible. Only when that's not possible, or when you really fall short of funds, you could talk to your banker to see if you can extend the loan period. If you're not already hit the hilt in terms of the loan period, that's a second option. But I think, especially in the current rate scenario where rates are peaking, it's not going to help you to prolong your loan. Banks easily move on to higher rates than reduce the rates when rates fall. So keeping that in mind, it's best that you just try and pay off your loans regularly. Now the question is, how do I get these funded? I don't have my monthly cash flows. What do I do? So you can look at the following options in the following ways. One, if you have had, if you're into your 30s or 40s, it is a likely chance that you would have put some money back insurance, some endowment policy, etc., which you would have been sold by at a time when you didn't know what they fetched, right? Most money back, most endowment policies are poor on returns. It's a given. Their returns vary anywhere between 4 to 5.5%, which is very, very low. So there is no harm, especially if you run them for 4 or 5 years. See if you can stop them, and stop as in you can try and get the money back, whatever be the surrender value. So this will give you some cash flow without really worrying about touching a very high returning investment. It isn't. So it's okay. But this is true if you really have a term insurance in place. It's important that you have a life insurance in place. For others who are listening, are still comfortably in jobs, they should have a life insurance in place to ensure that, any kind of calamity in the family can be, in your own life, doesn't put your family to risk. So money back or endowment is something you can dig into. If you have already created an emergency fund, that's an ideal thing, but most people would not have created it. And this is a time learning for us to know to create about 6 to 8 months of emergency fund and keep. So if you already have that, please use that for your monthly expenses. That's what it is meant for. And please try to see if you can pay off your EMIs with either that or getting back money from these endowment or these, money back policies. Three, if you have been an avid investor in gold, you hold a lot of physical gold, I think there is no harm. Don't try to kind of pledge them, just sell them and get some money out of it to keep the cash flow going. These are the times. After all, many people in many families invest in gold believing that it will come handy when times are not good. So perhaps you should put that wisdom into use if that was the idea behind investing in gold. So dig into, see if you can sell some piece of gold and also get your cash flows through this. So endowment policies, any emergency fund that you have created, physical gold, FDs if you need to break early, break them early. In the all this, if you really have no cash flows, if you're a double income earning family and one of you lose a job and the other has it, good for you. Keep it going and just try to maybe keep the EMIs going and pay for all the necessary expenses and postpone any negotiable expenses you had, like you planned to purchase something in the next 1 or 2 months. You could push it by 6 months, replacing any gadget, replacing anything else in the house. All that could wait. If you had planned to move to larger house with a higher rent, that could wait. All of those, and even downsizing on your house if you pay in a rental house, downsizing and reducing the rental. These are things that you can really cut back on until things are more comfortable for you. The very important thing is you can afford for some time to stop your investments, but as far as possible with investments, see if you can avoid touching your long-term investments, especially those invested in equities, etc. They are meant for long-term compounding. That's why I said, please take the endowment or the FD. It's okay to break them if you really needed the cash flows. But the long-term investments, which compound much more, keep them alive if it's possible for you. So those are broadly the things that, one can look at in terms of trying to keep the cash flow going.
The one trend that I've seen over a period of time is that it is between the 30s and 40s that most people let go. Beyond that, the percentage is very less. Though there are cases which actually pop up on social media, but not as high as the ones between 30 and 40. During the 30s and 40s, you're doing multiple things. Assuming you're already married and you have children who are into their primary school and maybe high school, and then you have your first car, and you already bought your house for an EMI, which will obviously for a maybe stretch for 15-20 years, right? And then you don't have much to fall back upon as far as savings is concerned, because of the fact that you don't have that kind of having worked in an organization for a long time. Things become difficult, I assume, at that stage. So do you think certain drastic measures are required? For example, pulling the children out of high cost education or schools and getting them into something much lower kind of fee, number one. Surrendering your housing loan and then getting into a rented apartment, selling off your car. I'm talking of situations which are really very bad, and especially it hits you when you're in your early 30s.
Right. Right. So I would like to believe, those measures should be a last resort. After all, for example, these are also not just financial decisions, they're highly emotional decisions, like pulling your child out of, a high-end school that you put because you aspired to give better education. At least that was the thought process. So although I agree with you, Giri, that many people would not have high savings, but people have assets that they don't realize they can cash upon. They would have some, like I said, gold definitely in place in most Indian households. They would have silver
Yeah.
articles. Some of them have antique things at home, of which value, paintings that would even be worth a lakh, or handwork, that would. These are things that one needs to just apply mind a bit and see if things that are physical in nature and have value can be disposed of to keep the pot boiling. But they may not always be enough. Then you look at the other luxury things, like you said, the car, and especially if the car is running with an EMI, you try to close that EMI. The house obviously should be a last option, but in general, let's remember, if our EMI is, like, say, within 30% of our income, you can actually manage even when you lose a job. The fact is, most of us borrow to the hilt, and therefore we find it difficult to pay the EMI. In such cases, yes, it would become inevitable for you to just take a smaller rented up house and, let go the house to the banker. But those are very drastic measures. I would still urge, most of us would have hidden assets like gold, which are also emotional, but you should be tapping into them in these times, definitely. And I think decision on school, etc., should be postponed, but not at the cost of taking new loans. So never take, first of all, it's hard to get loans when you don't have a job through established sources. And the worst thing is, if you go through other sources, which are not the regulated ones, your interest will be very high, extremely high interest. You could take a personal loan, or you could go to some smaller NBFCs that give you loans by pledging some things, but those will be at very high interest, especially when you're not in a job. So don't get into a debt trap by trying to you're trying to basically postpone the problem, but the problem compounds itself. So taking newer loans when you don't have a job should be avoided at any cost. So the question you ask ourselves, will I be able to manage the situation of my kid for another term or two? Will I be able to borrow from a friend? Things like that, where you don't have to pay interest, etc. Whether that's possible, that's feasible, then you try a little hard. Or you do this selling of discretionary things like your expensive tab or your car and things like that. But you can try and postpone the decisions such as school and home, etc., because those are big decisions. And let's remember, the liquidating the house, especially in a distress, would always mean that you are at a loss. So the seller is always the loser in many cases, but especially in such situations, the seller is the loser. So these are also times, if you still have a job, these are things that you now need to apply in your life to ensure that you're not in such a situation where you'll have to make such drastic changes to your lifestyle. See, normally they say about 15 to 20% of your expenses can be curtailed if you actually sit down to think about it. There's regular eat outs, or those movies, or those trips that one makes. All those cutting down will naturally cut down your expense, and you'll be forced to do that actually when one is not in a job. So once you become conscious of your spending, your cash flow automatically reduces. And if you had just some savings, and that's when you save for the rainy day, if you had some savings or some physical assets that you can liquidate quickly, use them first. I would say taking these drastic decisions have also a very big emotional impact on you or your child or your family, etc. So they can be the last resort. If one has to borrow, don't borrow, resort to these.
So coming back, let's go back a bit little. What are the three top things that person who has been laid off should do?
Yeah. So first thing is, you first keep track of your current savings that are there, how liquid they are, which are the ones that are most liquid, which are the ones that you cannot take out or sell. Like a house is obviously you can get money out of it, but takes time. So the liquid ones, see how much they will last. If they don't last, see if you have some physical assets that you can make use of, like gold. Next, see if you have policies that were sold to you 10 years ago, or when you started your job, that you can simply encash now and get whatever money comes out of it. And you could temporarily stop even other any other policy premiums that you're paying, or your SIPs that you're paying, etc. Right? So first, encashing the most liquid assets if you don't have an emergency fund, and then going for physical assets such as gold, and also financial assets such as money back policies, surrendering, etc. And clearly, the second thing is cutting back on your expenses. Make a list of the last 2-3 months of credit card and bank account spends that you have made, and see which are the discretionary ones. Just blank out the discretionary ones. There is no space for discretionary ones. You cut them off. The next measure, if you're living in a rented house, is to see if you can go for a house with a lower rent. Right. So these are the basic first steps that you do. And then obviously, you hope that you look out for a job and, get it in the next 3 to 6 months. For those who have not lost their job yet, please start saving right away and build this emergency.
Yeah, actually, I'm going to ask you that question.
Right.
The question that I'm going to ask you is about those who have not been laid off. But 5 years ago, let's assume before pre-COVID, it was not such a norm. I mean, it used to happen, but not in India, at least in the kind of scale that's happening right now. So what do you advise those employees whose jobs are not certain in any manner any longer now? It's not, even if you join the best companies, some of the best multinationals, there is no guarantee that you'll stay there for more than a year, because this is a norm now rather than something very unusual. What should they start doing right away?
Right, great. So, like I said, build first an emergency fund, over the next several months, where you ensure, obviously, you will have to put a higher chunk into this every month to ensure that about at least 6 months' pay is done in that emergency fund. Stop all other investments you're doing and put this emergency. This emergency fund can be a short-term deposit. It can be a liquid fund or a very short-term, mutual fund, etc. Anything which you'll be able to take out quickly. So at least 6 months of your regular earnings should have been built in that. Make sure you do that before you get into any other savings. The other thing that you should kind of look at is, if you don't have an health insurance, please take a health insurance right away. It does not matter that your employer already provides a cover. The thing is to not have a cover when you don't have a job, and that's when something strikes you or your family, then it's a huge drain on you. It's a huge burden on you. So make sure you have a health cover right away and keep it going at any cost. Pay that premium first. The other is, ensure you have a simple term premium. I mean, irrespective of whether you lose a job or you have a job, the fact is that, if your life is at stake, you don't want your family to suffer. So a term insurance consisting of at least, over the next 5 to 8 years of your annual income, plus at least all the liabilities, plus some amount that you would have thought of for setting aside for your child's education. Today, even a 1 crore policy comes with very low premium if it's a pure term premium. The premiums are not high, right? So you could consider these, and make sure basically your family is safe, and the health of your family and yourself is taken care of, but that's not a drain on the family. This emergency fund should keep you going, and in these periods, avoid any new luxury expenses or discretionary expenses, because you don't know, you are uncertain, your job is uncertain, so you don't want to commit to a bigger car or commit to a bigger house at this point in time. So just avoid that. That can be done when times are better.
Let me get into a bit of nitty-gritties here, and this is something that I assume confronts all people um, when it comes to three instruments. One is the endowment policy that you talked about, where it's attached to your insurance, life insurance, and um, your returns are, as you said, 4% or something like that. That's one unit-linked insurance, and then the third one, mutual funds. Which would you prefer among the three of them for any individual investor to start investing right from the day he gets into a job? Number one. Number two, should he go ahead and buy or invest in shares apart from the mutual fund that he does?
Right. So if you're new to investing, even starting with a recurring deposit or a fixed deposit, it's a good option. One doesn't have to get into mutual funds. Even this is good enough. The next step, in my opinion, should be mutual funds with a mix of equity and debt mutual funds as part. So the FD and the debt mutual fund can be part of the emergency fund. You don't need to create a separate corpus. As you're saving, set it aside mentally. It's just called mental accounting. Say this is for my emergency. The equity funds can start a little later when you have sufficient money to spare, you have sufficient savings. And I think stock investing is only for those who can afford to lose the money they put in the market. That's the mindset. If you cannot afford to lose something over the next 4 or 5 years, you should not be putting in stocks. So if you ask yourself that, and your answer is yes, I can, then you need to do the groundwork to be able to do it. And remember, FDs and mutual funds can be put with little to no knowledge about the products, but investing in stocks basically requires some knowledge.
This question may not be relevant, but I still need to ask you this, especially about those who get a far better salary. So high net worth individuals who was at the level of directors and vice presidents. They do get a lot of money on a yearly basis. Their income levels are high. They get ESOPs and a whole lot of other benefits as well. But they do get laid off now more often than before. And as we all know, the human tendency is that the more you earn, the more you spend. And what advice do you have for those kind of executives?
Yeah, so the assumption is that their savings rate would also have been decent. So
Mm-hmm.
those who are at that level would have maybe in their late 40s or 50s, so they would have had some savings. I think the
Mm-hmm.
best is to start, and very likely with such high pay they would have been already invested in mutual funds, in probably products like PMS and so on. What they can
Mm-hmm.
start doing is kind of use that corpus as a monthly income plan by resorting to something like a systematic withdrawal plan from their mutual fund.
Mm-hmm.
So that will act
Mm-hmm.
as like a monthly income, and they basically it gives you regular cash flow at a fixed amount. And
Mm-hmm.
until such time, you probably get another job, and or even if you don't, if your corpus is sufficient, you try to withdraw this. And at the same time, if you have equities, you allow it to grow so that your corpus keeps growing, so that you can use it for income earning purposes another 5 years down the line or 10 years down the line. So
Mm-hmm.
most of these HNIs would likely have a mix of bonds and mutual funds and PMS and so on. I think the deposits, the mutual funds, etc., can be used for a systematic withdrawal. The bonds, as and when they mature, possibly can get into the debt mutual fund pool to be used as a systematic withdrawal. And the reason why I keep talking of debt mutual fund, it lends itself to this kind of systematic withdrawal in an auto manner. No other
Mm-hmm.
product does that. Like in a deposit, you will have to go and kind of you get interest at best.
Yeah,
But the
yeah, yeah.
interest may come down, may go up. But in a systematic withdrawal plan, you can fix the amount and you can keep withdrawing. So that will
Okay.
have a better estimate of how much cash flow you need. So that's
Mm-hmm.
would be the ideal approach for such people. Very likely at their position, they would already have the other things in place, insurance, etc., etc. If they don't, more
Mm-hmm.
reason why they should have health insurance, even if they are laid off. Even at that age, I think it's important. Maybe in late 40s, 50s, it's better still to get insurance. That's when many of the lifestyle diseases also start
Yeah, yeah,
impacting
yeah,
one.
yeah,
So with their
yeah.
corpus, I'm sure they would be able to meet the premium. So that's also something they should put in place. Other than
Mm-hmm.
that, I don't think if their corpus is sufficiently high, then they should hire, in my opinion, a financial planner and do at least a one-time cash flow estimate of how much they need and whether there is a gap. Once they identify that there is a gap, it's easier to decide what sort of products to invest in, right? So if
Mm-hmm.
I don't need to take risk, I have enough corpus, then I will put them in low risk instruments. But if my
Yeah,
corpus
yeah.
is not going to last for more than 10 years, then I'll have to take at least some risk to ensure that my corpus grows now, right? So that's
Mm-hmm.
where
Mm-hmm.
you such people might need a fee based maybe financial planner to at least do an one time assessment for them.
Mm-hmm. Mm-hmm. So finally, let's look at the overall scenario. What would be your message to people like this, and what exactly would you want to tell them? Is there one rule fits all for everyone?
Right. Yeah, definitely. It's not one rule fits all. But the good news from my own interaction with thousands of investors over these years is that people do put out something for a rainy day, knowingly or unknowingly. It's just that it
Mm-hmm.
doesn't strike that it exists and you can tap it. Like I said, the gold jewelry that you would have bought is definitely an asset. You could, make use of it when you want to. And once you get down to the brass tacks, you will realize many of the expenses you're doing are discretionary in nature. The moment you see
Mm-hmm.
that they can be cut down, I'm sure it will give you comfort. And I'm reasonably sure globally, Indians are still bigger savers than the rest of the world. So that's
Yeah, yeah,
some
which is
comfort
true.
for us, right?
Yeah,
So,
yeah.
and in fact, many of the jobs that have been lost now, they're people abroad and they have the comfort of coming back home if they have to. I mean, if they're not able to get a job in the US, coming back here, there's already always a family to fall back upon, and expenses are lower in India than it is abroad, etc. So for those abroad, that's a big comfort. For those in India, I think you just have to see where your assets are today and which ones to tap first. That is all that you need to do. 90% of the times you will see that you have some asset. When you don't have, the best thing is to downsize. Like you had mentioned, whether it's a rented house or a house, etc.
Mm-hmm.
But avoid taking any loans on high interest basis. That's something that you should avoid when you don't have a job.
Okay, sure. Thanks, Vidya. Thanks for being part of the show. And thanks, viewers, for watching the Federal's Big Money. Thank you very much.